Hi, everyone. It's John Pocaroba again. It's time for a general market update. It's January 27th, 2023. It's been an interesting week. So as a reminder, this presentation is made by Rain King, LLC, and I'm an amateur individual growth stock investor not affiliated with IBD or MarketSmith. So our agenda is to review the January effect. We'll talk about the recent breadth thrust we saw on the markets a couple of weeks ago and look forward to what the expectations might be. We'll get into the market's character, and then we'll end with some emerging names of market leadership. So the January effect, the update. I won't go over these definitions. You can pause your video player. We've covered them before. We're really looking for the January barometer at this stage. So as a refresher, though, the Santa Claus rally indicator was positive. The first 5 days of January indicator was positive as well. And we're looking to see where we close on the monthly close in January. We're almost there, but it is looking good. And for those of you who are not familiar, the January trifecta is to get all three of these indicators positive. And you can see from the statistics, it's a very positive odds of good things happening in the ensuing year. Let's go a little deeper. Here's a couple of statistics from Carson Investment Research. When January is greater than 5% for the month, you can see that the average gain can be really, really positive. We're currently in the 6% range, so it looks like we're going to have a positive January. That'll complete the trifecta, so that's a really good thing. Now, to look even closer with some of this data, if we are coming off a down year, as we had last year in a bear market, and you get the trifecta the following January, which it appears we might, here are some data for all of those conditions. And you'll see that the returns are quite juicy. The average return in those situations is 27.1, really, really positive. So we'll see where we close in a couple of days if we can stay above the December close. Now, interestingly enough, if we were to get the average S&P return of 27%, that would bring us to 4876 on the S&P, which would be all-time highs by the end of the year. It's hard to imagine talking about that, but that's what it would be. Another tidbit, the NASDAQ 100. When the NASDAQ 100 begins the year with 3 consecutive gains, weeks of gains, also very bullish. You can see here the years that we've had this situation where the first 3 weeks have had gains for the NASDAQ 100, and we actually had a 6.2% gain. And you look at the end of the year results, they're very good. You can see the average gain is almost 28%. So it's another really bullish sign. Again, some of these are more, factoids really, but they definitely show that things are improving. Let's get into the breadth update. The breadth thrust that we saw on January 12th. You can pause your video player. I went over this slide on the last video, but I'm not going to take the time to go over it now. This is the detail of what the Whaley breadth thrust actually is and how it's calculated. The most important thing to understand is we had a breadth thrust on January 12th with a trigger. So most importantly, where are we relative to this? And so I put together and gathered a few signposts that we can use using the S&P 500. And we want to ask ourselves the question, what can we use to help guide us with forward expectations? We're always trying to understand what is normal action in the market and what is abnormal action in the market. So regarding this type of thrust, in the first 6 weeks, 3 to 5% pullbacks would be completely normal and contained. So that's what we could probably expect. If we start getting pullbacks 6, 7, 8, 9%, then something's probably wrong with the market. So in the first 12 weeks, the first 3 months after the thrust, forward gains are pretty good. They're approximately 12% from the thrust. And the pullbacks in that first 3 months are in the 5 to 6% range. That would again be very, very normal. Looking 6 months forward, forward gains are approximately 17%. Now, it's important again to note that none of this predicts anything. They're just some signposts that help us monitor the market's action to determine are things acting normally or abnormally. Now, I decided to try and put these things on a graph, see if it would be a little more helpful. So this is the S&P in this blue line chart, and this is the January 12th thrust. Our very first pullback was only a meager 3.2%, so totally in line. I put some lines on the chart. This is the 3-month marker. If we were to get a 12% gain in 3 months, that would bring us to the middle of April, and we would be somewhere around the 44.61 area, which you can see is just below the March highs in 2022. The 6-month marker would be out in July, and that'd be the 17% gain up to the 46.60 level, which would be right around the March highs. And if we continue, and again, taking the January trifecta, after a down year, using this average gain of 27, 28%, you can see this is actually would be at all-time highs on the S&P. Hard to imagine, given what we've gone through the last 12 months, but there is the potential. One of the things that I'm looking at is certainly the downtrend line that's been going on in this bear market. I put out a tweet a few days ago, and it was if, and it's a big if, we can break this downtrend line, which we seem to have done initially. What's important as we come back and test that line, if we can hold, we could see some real surge in buying here, because the shorts will have to cover, and some of the institutions will be playing catch up because they're missing the rally. So a lot of interesting markers here and signposts to help us with managing expectations. And again, I'll repeat, none of this is predicting anything, just trying to help us with reading the market. So let's get into the market's character, which has certainly been changing since January 1st. So on this chart, this is a chart of the NASDAQ composite. And I put on a couple of things. One is the follow-through day. We had a day 7 follow-through day way back in October. And what's important, I've also marked in green these accumulation days. These are very positive days in the market where we're getting good gains, usually on an increase in volume. And you can see we have had a number of these, actually 1, 2, 3, 4, 5. I haven't looked at today's, but 5 so far in January, and January started in this yellow zone here. I've also put some kind of key news and what the reaction to news has been along the way. When we put in the low on October 13th, that was a key day. We noted it when we had our videos. The market was reversing up on bad news of the CPI, and we got some good CPI news. And then the market was up again on bad news of a hot jobs report. We look for this characteristic of the market shrugging off news as being bullish. And then just a couple of days ago, Microsoft has their earnings. They gave poor guidance going into the future, but the market sold off early but reversed up, which was very bullish. I note this accumulation day here. Some people say this was the original follow-through day. Really, the way follow-through days are viewed is, the rally is not officially dead until you undercut the lows of that initial rally. And even though we undercut the follow-through day here, we came way back down, we never undercut the intraday lows of October 13th. So at least the way I'm interpreting things, about this follow-through day, which was number 7 in the bear market, was still in play. If you want to interpret it as this was the follow-through day, you're sure to do that yourself. There's nothing wrong with that. The bottom line is don't worry about the labels. The most important thing is the green on this chart. We're seeing accumulation after we retested the lows. Very bullish. Back in August, we talked about the psychology of the retest of lows. We had talked about the devastating bear market have even hurt a lot of the professional traders on the way down. And at the new lows, even the pros had damaged mental capital because they're underperforming at their jobs. Once we got that initial rally, and we had that rally in July and August, but in early September, it rolled over. It really turned out to be a bear market rally. It came down. We've retested the lows, and I've always said the retest is where the rubber really, really meets the road. Even the pros, when they see this bounce, are saying, is this just another bear market rally? And we're basically come up off those lows, and we're starting to break the downtrend line. So we're somewhere over where this star is. And the question is, are the pros going to uh, start to buy because they're missing the rally, support the market, or are the pros going to bail out and the market really falls apart? So far, from the last chart I showed you about the accumulation days, it looks like they're going to be buying, but we take it day by day. So there's, the market is a big tanker, and it's tough to turn a tanker. It takes months and months, and even since October, we're talking 3 months or so for this to start to build some positive bullish signs and breadth improvement. But there are signs that the tanker is making the turn. So how growth stocks set up? I really want to refer you to watch again the August 26th video, because I go over this in a fair amount of detail, and go right to the 8-minute mark, the 8:10 mark. You can actually hear the dialogue, because I'm not going to go through everything in great detail here, but I'm encouraging you to go back to that. But the quick recap is, when stocks are coming out of bear markets, and I'm using here the 1990 bottom, there's really two types of ways that growth stocks will set up. The first type are leading stocks that will break out during the initial thrust and rally. When you have your initial low, you get this rally, you'll have stocks breaking out. In 1990, we saw Cisco, we saw Amgen. And the type 2 stocks are, once you've made the retest, those stocks will be building bases, and they won't break out until the retest is really, really pushed higher. Home Depot was a great example of that. And I'll take a look at each of these, and then we'll look at what's happening in today's market. So here's the Amgen, which is a type 1. And you can see, here's the general market, and here's Amgen. It really broke out on the initial thrust off the lows. And then when we had the retest, Amgen was already up and out, formed a pause. And then when the market really, really followed through, Amgen took off. Type 2 was Home Depot. And again, these are stocks that they're in the base building process off the lows. You'll notice that when the market came back in and retested, that's exactly where the handle was being formed in this big Home Depot cup with handle base. And then when the market followed through after the retest, that's when Home Depot broke out. So those are the two types we're looking at. So what are some of the type 1 leaders that you might want to train your eyes and look at on your watch list? So I've pulled a couple of them here. Here's Rambus. Rambus surged off the lows in October. And then you'll notice as the market came back into a retest, what did Rambus do? Well, the stock paused, consolidated its gain above the breakout level. And then as we've moved higher after the retest, Rambus is moving. Same thing with First Solar. It broke out of its long consolidation, came back in and formed a flat base, and now it's starting to continue its move. Here's BioMarin, which is a biotech, broke out way back here out of a double bottom. And it paused, came back into the 50-day as the market retested, and actually it's gotten some good volume on the bounce off the 50-day, the 10-week on this chart. And even Caterpillar, some of the industrial, big base was formed as it came up off the lows initially. Then it formed a flat base. Looks like it'd be about a 5-6 week flat base. And after the retest was completed, Caterpillar has been moving out of that base. So those are all type 1s. Let's look at some type 2s. So type 2s are stocks that are deep in their bases still, but they're forming proper bases on the retest. So you can see Axon, big, large base. And you'll notice that it came up, still hasn't reached all-time highs, but it's formed a cup base. And this cup base is fairly tight. You can see tight closes. You can see the relative strength is there. So this stock is also perched and trying to move out. Lee Auto, way down in a devastating correction, but you'll notice it had a prior uptrend off the lows, and then it's formed a cup with handle. The relative strength line has started to really improve, even though it's way, way off of all-time highs. It's setting up as a type 2 setup. Credo is an interesting IPO. The thing that's interesting about this one is it's an IPO, very wide and loose structure here in this kind of loose cup. And the second cup was a little bit tighter, but it's this third base that forms this third cup. I wouldn't call it extremely tight, but it's much tighter than these previous two formations. And it broke out this past week, even though it hasn't hit all-time highs yet. It's still a constructive situation. And then a big cap name, NVIDIA, you can see still well off its all-time highs, but came off the lows with a prior uptrend, formed a cut base on the retest, and now has broken out. It's actually above its 200-day line. Those are really things that we call type 2. So when you're analyzing your stocks and your watch list, try to understand, the situation. It can help guide you with how to play the stock. So we're going to go to the emerging leadership. And the way that I like to do this is I've taken a chart here of the NASDAQ on a daily chart, and then I've plotted all the breakouts since October. And I've color coded them just to kind of get the flavor. So these orange names are all the technology names. You can see technology was breaking out. Some of these, Pi and Rambus were breaking out on that initial follow through day, very close to the initial follow through day in October. There are some Chinese names that are breaking out recently. Leisure and gaming has been really, really strong in the past month or two. You can see that Las Vegas Sands and Wynn. There's biotech names I've sprinkled around that are breaking out. And then most recently, as we made the retest, you can see a lot of orange. These are all technology names: AEHR, 4, Credo, Shop, Mobileye. Seeing much more technology, growthy type names starting to move. We also still have some retail, Crocs, TJRX, Melly has been very, very strong. And then we have industrials and oil. Off this retest, you can see the Schlumbergers, the Halliburtons, Valair, Oil, Caterpillar. So there's definitely quite a bit of breadth going on here. And amazingly, the home builders are moving as well. EHI and Lennar have broken out off the retest. So really good picture of potential leaders here that are really breaking out and emerging. So hopefully this helps you with some names to look at. Many of them are extended, so be very careful about how you approach them now. So to wrap up this recap, definitely the market's character has changed. We pointed that out on how we're getting much more accumulation days and we're getting some more big blue volume spikes, which is positive. But be cautious. We have a Fed meeting next week. We'll have to see what the Fed does. Hopefully, generally people think it's going to be a quarter point hike. Let's see if that's in line. Again, I mentioned some of the names are extended. Don't have FOMO and chase extended stocks because the pullback will clip you. So let the market, it should be pulling you in as you're incrementally getting some positive feedback and your positions are turning green. You kind of earn the right to put some more money to work. To me at the moment, it seems that 30 to 50% exposure seems to be a good range, at least for me. Some of you are more aggressive and some of you are more conservative. That's up to you, but that's generally the range that I'm in right now. Be selective. Not everything is going up. So insist on a pretty good setup, and hopefully you get some more volume to come in to confirm that the institutions are behind your name. And I think it's also important to stress, watch your average cost like a hawk. If you add to positions too quickly and raise your average cost, one of these normal pullbacks of 3 to 5% is going to put you under a lot of pressure. So be very, very careful about planning where your average cost will be before you make that additional buy. So before we wrap up, I wanted to share something really important. The next Boston IBD meetup will be February 7th, and we have the pleasure of having Brian Shannon of alphatrends.net will be with us. He has a brand new book on the anchored VWAP. So he is going to be with us to share his favorite ways to use that. We'd love to have you join us. Just go to meetup.com search for the Boston Investors Business Daily Group, and you'll get the link to that site, and you'll be able to sign up. The Zoom seating will be limited, so you must RSVP. Whether you're going to attend live or you want to get the recording later, please RSVP. I don't think the site is open today, but it should be opened up this weekend. So look for that very shortly. And we would love to have you join it. It's going to be a great night with you. So thanks for joining me for this general market update. Here's where you can find me on Twitter, YouTube, my videos if you want to go back and look at some of those. And if you want to have a comment, a question, or thought, you can reach me at RainKingBullBear at gmail.com. So everybody have a really great weekend. I hope this update was useful, and we'll talk to you and see you soon.